Okay, now the danger about having stop losses, and this is something you guys need to realize as well, is that it's all good and well having a stop loss in the market, but you need to be aware of the fact that if your broker gives you a trading platform that has direct market access, prices can gap through your stop loss. So execution is not guaranteed, particularly in situation where there's an event overnight and stock prices either gap up or gap down with market uncertainty. There's a very real danger of this happening to you. So I've said here, mind the gap. This is actually a gold chart on GLD, which I've zoomed in on the candlesticks. And this is kind of the danger I want to point out. So let's say, for example, you were in the trade around this level, you were trading within these candlesticks, and your stop loss was somewhere in this gap. And the next morning, the market opened way down here. That physically means that your stop loss order would not even have triggered, let alone traded. And the only time that stop loss will trigger or trade is when the trade trades back up towards you. So missing your stop loss is very real. So you guys have to monitor your stop loss levels, and especially when there's a lot of turmoil or uncertainty. You know, when maybe you're expecting a big announcement out of the US or Europe, or there might be the potential threats of war, geopolitical risk. Make sure that you're aware, and don't shout at your broker if your stop loss is missed, because this is very real. People have gapped through stop losses on many, many occasions. So now I just want to talk about pulling the handbrake on a bad trade. The stop loss has quite a few uses, and I'm just going to walk through the basic principles and a couple of basic stop loss strategies for you. So we're going to discuss the percentage stop loss. We'll also look at some patterns. How do you put a stop loss when trading patterns? Support and resistance, probably the most effective and most successful way of avoiding to lose money. Also the volatility stop loss, very important. Guys often get in and out at exactly the wrong time. And then a time stop, also very important, because trades end up costing you money if you hold them too long. So let's take a look at some of these. So first of all, where you place your stop loss all depends on your appetite for risk. Some guys are risk averse and prefer to have stop losses a little bit tighter, where other guys are a bit more aggressive. Give the price a little bit of time to run away from him, not panic a little bit, maybe take an average. He's got a bigger appetite for risk and is willing to watch a position drift a little bit further out of the money than somebody else. But the bottom line is that you know yourself better than anybody else. So you need to identify how much risk you're prepared to take and where you're going to take your bloody nose if the trade goes against you. So the percentage stop loss, quite basic. This is where a trader will place a stop loss a certain percentage away from the entry point according to their risk tolerance. So what I'm saying really as an example, if a trader enters a trade looking for a 5% move on a stock and the share price decides to drop 2%, or he decides that if the share price drops 2% from his entry, he wants to be out of the trade. Plain and simple, it's all in percentages. He wants to make 5. If he was trading a single stock future or ECFD with a little bit of gearing, you know, it relates to about a 50% move to the upside if he was 10 times geared, and a 20% loss on the margin that he used at 10 times gearing. So percentages are a nice way of just keeping it nice and tidy.